In Lesson 1, you will learn about financial literacy. Part 1 of this lesson will be on credit. Part 2 will cover financial aid. In Part 1, we will talk specifically about the reading you should do, credit reports and FICO scores, budgeting, and the quiz and discussion assigned for this module. Before you watch this video, I recommend that you read pages 301 to 308 of our course textbook. This book is an open educational resource and available for free. Reading these pages will give you some background information on the importance of this topic. Having knowledge of your credit score and FICO, Fair Isaac Corporation scores, is critical to your financial future. A credit report is a document compiled about you that lists all the things related to your credit. Components of your credit report include personal information, accounts, hard inquiries, collections, and public records. Your FICO score is a numeric value for your credit report. Factors are similar in that they include credit use, payment history, derogatory marks, credit age, total accounts, and hard inquiries. In this section of the lesson, we will go into more detail on these two items, and I will give you the opportunity to use free resources to obtain and monitor your credit report and FICO scores. There are three major credit reporting agencies in the United States: TransUnion, Experian, and Equifax. Each of them keeps a credit report on you, whether you are aware of it or not. Usually credit agencies do not start logging a person's credit until they turn 18. However, if a loan, credit card, or the type of credit was taken out with your name, you may have a credit report generated at an earlier age. Each agency has a report on you that keeps track of your personal information, like your name or name changes, social security number, or tax identification number, mailing address, work address, and employer. This personal information is the first component of your credit report. It is not uncommon for individuals with an identical name to get mixed up on a credit report. This is especially true when those in the same family have the same name. The meat of the report starts with a listing of all the accounts in your name. This includes any accounts that you were a co-signer on or authorized user of. It includes things like loans, personal, auto, mortgage, student, etc., and leases, housing, vehicles, buildings, etc., and credit cards. This component also includes closed accounts. Even if a loan has been paid off, it will remain on your credit report. The next section in a credit report deals with hard inquiries. A hard inquiry is when an organization wants to access your credit report and credit score in order to offer you credit. Before a loan, lease, or credit card is issued, it is common for the company to give the credit to run a hard inquiry. Hard inquiries stay in your credit report for up to 2 years. After a listing of all of your accounts, both open and closed, it will show collections in your name. This is when payments have not occurred on time and the debt has been turned over to a collections agency. Having even one of these items on your credit report can strongly affect the amount of money banks will issue you, so be careful to always pay on time. The last section of your credit report is public records. This includes any bankruptcies or settlements that have been laid against you. They also factor into how a financial institution assesses your ability to handle money they might loan you. FICO, or Fair Isaac Corporation score, is a numeric value of credit, of the worthiness of credit you have. They normally range from 300 to 850, with 300 being the worst and 850 being the best. Each financial institution may have its own credit range. Some nowadays even go up to 900 instead of 850. The factors of a credit score are credit use, payment history, derogatory marks, credit age, total accounts, and hard inquiries. Credit use is in terms of the percentage of use of the credit given to you. The more credit you have, the less a debt counts in terms of percentage. For example, let's say you have 100K in credit. If you have $0 in debt, you have a 0 credit debt ratio. If you have 1K in debt, you would have a 1% credit debt ratio. However, if you only have 50K in credit and you use 1K in debt, that's a 2% credit ratio. The next section of your credit score is the payment history. It deals with how well you've consistently paid your debts as promised. This factors into roughly 35% of your credit score. This section also includes derogatory marks like bankruptcies, tax liens, or settlements against you. Your credit history or credit age is the amount of time you have had credit. The amount of time you have had credit, the better. So it is common advice that when you open up your first credit card, that it not have an annual fee and that you never cancel the card, because canceling your earliest card will severely affect your credit history ratio. Try to keep it open as long as you can. Total accounts is the number of accounts you have or have had credit on. The larger the number, in general, the more trustable a person may be with credit. However, keep in mind that opening up a credit card and then closing it right away will affect your credit history or credit age. The number of closed and open accounts you have will develop naturally over time. There is no need to rush to make this number go up. The last credit factor in your credit score is the number of hard inquiries you have had in the last 2 years. And hard inquiries when an organization wants to access your credit report and credit score in order to offer you credit. In general, the more you have your credit score pulled, the more you need money. If you continually need new money, banks may not trust you to lend it to you. You can view your credit report from each of these three major credit reporting agencies for free once a year by ordering via http://www.annualcreditreport.com or calling 1-877-322-8228. If you have a credit card, the bank or credit card company who issued the card may offer a free FICO score as well. A third alternative is Credit Karma. They show you your credit score and weekly report in exchange for letting them advertise and recommend new credit cards to apply for. Being able to allot your resources is key to managing a budget. In this lesson, you will discover the average amount of income someone in your profession earns and the expenses associated with living in your desired location. One of the key points of budgeting is to know how much you are going to spend and how much you are going to earn. To help you estimate this for your future career, you can access the Bureau of Labor Statistics website. They list the average mean annual wage for the majority of jobs in the United States. Once you're on the website, you can search by area or field. Alternatively, you can scroll to view each individual career. Keep in mind that this is the average, not the starting income of professionals in that field. You can check for the average salaries of a variety of careers and professions that you or your friends are interested in. You can even find out what the average income of someone in your parents' line of work makes. The second part of any budget is to estimate the expenses one would have. There are a lot of things to include in expenses: income tax, health insurance, rent or mortgages, property taxes, homeowners insurance, utilities, car loans and leases, car insurance, transportation, groceries, cell phones, and more. A budget is simply working out how much one makes or earns in comparison to how much one is spending. After reading the textbook and watching both videos on financial literacy, please take the 10-question quiz on financial aid and participate in the discussion board concerning credit reports and FICO scores and their importance to one career. To review, we talked about the reading that was assigned, the components of a credit and FICO score, and the budget assignment, and the quiz and discussion that are due in this module.